Hi, my name is George Dagnino. I'm the editor of the Peter Dag Portfolio Strategy Management. What I would like to show you in the next few slides is what I think is going to happen to 2023. And I'm using very specific indicators. And I'm going also to talk about what are the most likely performance of the various sectors. Let's dig into it. My approach to forecasting is to examine business decisions because I believe that they drive the business cycle. This video will show you how I use these indicators to predict the major turning points of the stock market, commodities, and interest rates. I will also discuss some specific ones that I think are very important. But the whole idea is to give you what are my thoughts on the outlook for stocks and sectors, commodities, gold, Bitcoin, bonds, and the international markets. My forecast start with the understanding of what is the direction of the business cycle. This is when the economy starts growing. This is when eventually grows even faster, and then interest rates, inflation rises. This is where profits start slowing down, and this is when all the excesses created in phases 2 and 3 are corrected, meaning inventories are going to be brought down, inflation and interest rates go down to the levels enough to trigger the phase 1, and the growth starts all over again. In order to find out where we're going, we have to understand where we are coming from. And this is why I want to go back to phase 1. This is when the economy started picking up strongly in 2019-20. Let's see what happened then. Because of the pandemic, government spending, and this is the change in billions of dollars in government expenditures, huge amount of money was thrown to the economy. So a lot of money, trillions and trillions of dollars, around 9-10 trillions. All that money went into bank deposits to be spent. By the way, this is where money is created, by the banks. When the banks have the bank deposits, they re-lend it, and that's how they create liquidity. Okay, so let's see what happens. The federal government pumped a ton of money. A lot of the money went into the pockets of the consumers. The consumers deposited the blue line into bank deposited, creating money supply. Let's see what happened next. Consumer deposited the money in the banks, and the banks created money supply, which you can see soared, 25% year over year, huge amount of growth. Business, seeing that consumers wanted to spend and spent a lot of money, what did they do? When they saw that sales were growing faster than inventories, this is what this ratio means, that sales are growing faster than inventories, they started producing as much as they could. And that's what business decision does. However, this huge demand created supply chain disruptions. Of course, this huge amount of money being printed created strong growth in the economy because, again, business was busy making money. And of course, when sales grow fast, business ramping up production, profits rose dramatically in the period 2021. Of course, this huge increase in liquidity created, again, do not forget, by the tremendous government stimulus programs, created soaring stock prices up 20-25% in 2020, 2021, caused by this excessive liquidity. So what we have seen is that business, to meet the demand of the consumers that was huge and was created by huge government programs, ramp up production, and business grow. So now we are entering strong growth in the economy, and we are entering into phase two, transitioning to phase three. Again, remember, I'm trying to get all these changes in phases because then the forecast you will see becomes almost automatic. That's the whole idea behind what I'm trying to do. The improved business due to increasing productions to build inventories. Of course, building inventories requires raw materials. So you see all raw material prices from copper to lumber to crude oil to nat gas, agriculturals, everything went up. And this is typical now, the business transitioning from phase one to phase two, when you experience rising commodities. Let's see what happens also at the same time. Well, one of the things that business needs to build inventories is borrow money. To borrow money to improve capacity, to hire people, to buy raw materials, to expand and improve capacity. So they go out and borrow money. And this is what, by borrowing money, then the demand for money increases. And what you see is interest rates start rising. An interesting thing of this chart is that, by the way, commodities started rising and short-term interest rate started rising almost at the same time. But the interesting pattern of this graph is that the Federal Reserve followed by roughly a year the increase in interest rates caused by business decision. And this is my basic point in this, the way I look at the business cycle. Business makes decision. The Federal Reserve and the government tries to catch up with what business does. And so you see that the Federal Reserve understood that interest rates were going higher, so they increased the interest rates charged to the banks. So far, what we have seen is that the free money from the government and from the Fed created a booming economy, but there is no free lunch. So at some point in time, we were bound to pay the piper. Let's see what happens next. Well, at the end of phase two, we had what is really a perfect storm. What you have is excessive liquidity, a booming demand, business trying to build up inventories, raising, of course, requiring commodities, requiring rising interest rates. You have rising commodities, wages with employment going down, and then the final act is soaring home prices and consumer prices. So, and that's the tail end of phase two. Now we are in phase three with inflation very high, housing prices soaring, consumer prices at 9%. So now you have to have the correction phase, the slowdown phase in phase three and phase four. Let's see what happens. Consumers are 72%, 70% of the US economy. And as soon as the inflation started rising, consumer sentiment started coming down. In other words, that was a sign that the purchasing power of consumers after inflation started declining. That's the most important development that follows rising inflation and rising interest rates. And this has a whole cascade effect on the rest of the business cycle. Let's see how. The business cycle is now sliding from phase three and into phase four. Let's see now how this is going to happen. Beginning in 2021, government spending and government stimulus started to slow down. So consumers had less money to spend, and you can see here the bank deposits eventually started slowing down, and the whole thing, what really means is that liquidity in the system started slowing down. Let's see now what the effects of this is going to be. We said before that consumers with rising inflation, they, of course, pessimism increased tremendously because they realized that the purchasing power was decreasing after inflation. So how this business sensed what was happening? Well, look at this curve. This curve means that inventories are now rising faster than sales. Here, sales were going faster when it was booming, but now that consumers are slowing down the purchases, you see inventories rising faster. This is not what you want to see as a businessman, because you know that your profits are going to be under pressure because of the cost involved in producing and carrying inventories. And this is what happens. This is sales, and this is inventories, is the red line. Sales started slowing down after the booming period. Business, of course, were ramping up production to go inventories, growing at double digits, 14% year over year. This is all after inflation. And of course, as sales coming down below the level of inventories, business has to reduce inventories. Now, this is another important piece of information from this chart. This is 14% growth. This is huge. Now, historically, inventories grow like the economy, around 2-3% after inflation. So now what you have to expect for business is to carry down inventories down to the levels that were historically normal for their business, which means this curve has to go down to 2 and 3%. That is beginning to give you an idea of what the forecast, the outlook is going to be. This is process. It's not going to happen overnight. It takes months, months, and months. Of course, the process of slower liquidity, business trying to cut production and to cut inventories, consumer purchasing power declining due to the rising inflation, you shouldn't be surprised that the economy is slowing down and will continue to slow down. But this is the most dramatic effect of what has been happening, and of course how business is responding to it. When the economy was booming, business was making a lot of money. But as soon as consumers started slowing down demand and inventory started growing up, rising faster than what they wished, in fact, faster than sales, you saw profit coming down. So this profitability is going to go down until when? Well, it's going to continue to decline until inventories are brought back into equilibrium to sales growth. Of course, as business cuts production, they reduce the purchases of raw materials, and what you see is commodities coming down. And since consumers started slowing down demand, as soon as inventories went rising too rapidly, you start seeing commodities weakening. The exceptions, some exceptions are energy, although even energy, where is here? Here it is. Energy is also coming down. Agricultural prices are still firm, but the basic trend of commodities has been down due to this reduction in production in order to keep inventories from rising too rapidly. Of course, when you cut production, you don't need not only raw materials, but you do not need to borrow as before. So you reduce your borrowing, and therefore you are placing downward pressure on interest rates. And this is why interest rates now have stopped rising, and the odds are that interest rates have peaked, especially because, as you saw here, they are below the Fed funds rate. And when this happens, usually we are very close to the peak. Why? Because the Fed is now recognizing that business is slowing down because they are aggressively cutting production in order to control inventories. So this is most likely the peak in interest rates. This chart shows the growth in liquidity, which now is slowing down quite sharply, and this is the response of the stock market. This is the change in stock prices, and you can see the stock prices rose sharply until 2021, but this is when profits peaked, and this is now the stock market. The growth of the stock market is following very closely the trend in liquidity. And this is what I mean when I say in phase 4 there is the correction phase, because now with the liquidity slowing down, you saw stock prices slowing down, and even home prices slowing down, inflation slowing down. So you see that in phase 4, all the excesses created in the upper phase from 20 to 21, now one by one, they're basically in a cascade coming down. This is another way of looking at the relationship between inflation and interest rates. As you can see, this is the 10-year yield. The 10-year yield follows very closely the trends of inflation. So with inflation coming down because of all the reasons I discussed in the previous slides, probably we are very close to a peak in long-term interest rates. What we have seen here is a transition of the economy from 2021, strong growth in liquidity, strong growth in the economy, strong inventory accumulation because of strong demand. Of course, strong demand means rising commodities and rising interest rates and rising inflation. But then purchasing power declines because of rising inflation. Inventories start growing faster than sales. Their business therefore cuts production, and eventually what you see in phase 4, everything that went up in phase 2 and 3, now they're coming down slowly and steadily, from profits to commodities to interest rates to inflation. And eventually the bottom will be here. When will the bottom be here? The bottom will happen when the inventory are brought down to levels consistent with sales growth, when both sales growth after inflation and inventory after inflation grow at around 1 to 2, 3%. Let's see now what is the impact of all this on the stock market. This is the business cycle as we computed from market data. And what it shows is that during this up phase, this is phase 1 and 2 of the business cycle. This is phase 3 and 4. Phase 1 and 2, this is phase 3 and 4. I wrote several articles on the subject, but which are all available, by the way, in the website www.peterdag.com. And what I found and what I showed is that during this phase, the sectors outperforming the market are growth sectors, such as industrials, such as financials, such as commodities, energy. During this down phase of the business cycle, the defensive sectors outperform, and these are utilities, staples, and healthcare. In 99.9% of the cases, bonds are also outperforming stocks, but not in 2022. And what happened in this business cycle is happened many times before in a down cycle. And what you see is from the peak, when I told you that the peak of the business cycle was in the middle of 2021, when profit peaked, the liquidity peaked and all that. And what you see is these are the 11 sectors of the Standard & Poor. The 3 sectors that outperformed are healthcare, utilities, and staples. This is the S&P 500 is here. So in a down market, again, even in an exceptional cycle like this one we had, the 3 sectors outperformed. The energy sectors has been an outlier because of all the messy decisions that they were made in Europe and maybe also in the United States. Let's see now what is the likely bottom of this bear market, and let's see what the interest rates are saying. This is the interest rates on the 2-year bond yields, and the red line is the stock market. Now, most people are saying, you know, let's wait for the Fed to ease, which doesn't happen. It's already happened because business is not borrowing anymore. But people are saying that when interest rates decline, it's bullish for stocks. Not so fast. This is when interest rates peaked, but the bottom of the stock market happened a year and a half later. Here, interest rates peaked, but the bottom of the stock market happened roughly a year later. The same thing in this period. It all happened, the same thing here. It happened many years, a couple of years before. So the decline in interest rates doesn't necessarily mean that there is a bull market right under the corner. On the contrary, we are just in the middle of it. The yield curve is measured as the difference between the 10-year yield less than 2-year yield. Here the curve is steepening, here is flattening. When it's below zero is inverted. As you can see now, the yield curve is inverted at levels that were last seen in the 80s. But what is the relationship of the yield curve with the stock market? I'm going to give you only one, but it's very telling and confirms what I said before. When the yield curve starts flattening from being inverted and goes to zero, it takes roughly a year before you see the bottom of the bear market. When this goes above zero, it takes a year before you see the bottom. Here start flattening and you see roughly a year before you see the bottom. Here is the same thing. So this curve has to come here to at least to this level to start thinking about a bottom in the bear market anytime in the next, I don't know, after 6 to 12 months. So we are really pushing the bottom of this bear market towards the end of the year. What about gold? Well, gold prices like declining interest rates, probably because when interest rates decline, usually they decline when there is a recession or really bad times, so people find refuge in gold stocks. So when interest rates rise, really gold and gold stocks don't do much. But when interest rates decline, this is when you see the big appreciation. Here interest rates started rising and gold stocks did not do much. Now gold stocks are beginning to strengthen. This may give credence that what we are seeing here is a peak in interest rates and the real unfolding of the recession. Well, there is a lot of emotion about gold and especially about Bitcoin, but one of the things that seems, by the way, this is the business cycle as is computed by us, and this is the price of Bitcoin. And what you see is a typical behavior of Bitcoin like any other commodities. When the economy strengthens, Bitcoin is strong. When the economy weakens, Bitcoin is weak. When the economy strengthens, Bitcoin is strong. But when the economy weakens, Bitcoin doesn't go anywhere. And since this business cycle is likely to continue at least another 6 or 7 months, given the relationship between inventories and sales, the weakness in Bitcoin is probably going to continue. I have another video about international markets and had quite a bit of success actually. I was very pleased. And you can find it on my YouTube channel, which is at George Dagnino 5017. And what the gist of the article, I show many more data, is the business cycle of China, Japan, the Eurozone, and OECD, which is the developed countries. This is all published by an international organization in Paris. And what you see, the business cycles, the ups and downs, the ups and downs, the same thing for the total economy, which, by the way, correspond exactly to the business cycle that I just showed you before that we compute from market data. So all these business cycles have exactly the same turning points. Exactly, all the developed economies have exactly the same turning points, up or down. Now, this has huge implications for the stock prices of these countries. As I said in the previous slide, I showed all this foreign country stock markets, and I showed all the incredible synchronicity of the turning points. But I just took one, and is the European stock market, which, by the way, has not done anything since 2000. This is the peak in 2007. Has not done anything since then. But what you see is all this ups and downs, ups and downs, ups and downs, ups and downs, correspond exactly to the turning points of the business cycle. By the way, if I show you the U.S. stock markets has exactly the same performance, the only thing that the U.S. stock market is much stronger than the European stock market. This is a buy-sell indicators that I have, and I gave a sell signal here. And this is the performance of the European market relative to the US, which is going down, saying that the European market has been, since 2007, has underperformed the US market. All the countries of the developed world show exactly the same performance. Maybe Japan shows a little stronger than Europe, but most all of them are roughly flat in showing this ups and downs corresponding exactly to the turning point of the business cycle. So what is the implication? The implication is when people say I buy foreign stock market, really you don't buy, you buy volatility, because what you hope that this leg of the stock market, let's say in Korea, is stronger than the up leg of the US stock market, That's really what you do, because you are not timing this point or this point or this point in a different way, because these are exactly the same turning points of the US stock market. So what you do, you buy volatility, you buy the relative strength over a very short period of time. So what is the bottom line? The bottom line is that there is a major inventory correction. And the reason is major because government spending and the Fed forced business to build a lot of inventory because of the huge amount of money that government and the Fed put in the pockets of consumers. And of course, this has created inflation, declining purchasing power, and now we are going through an inventory correction that is likely to last until the end of 2023. So this is when I think the bottom of, you start thinking about finding the bottom of the business cycle. In the process, commodities will remain weak, from Bitcoin to copper to oil to anything. And this is a trend until, as I said, in the fourth quarter of 2023. Interest rates always follow commodities. There has been an exception in 2022, but I think that has been so unique that eventually historical patterns eventually will prevail again. So interest rates and bond yields are going to follow commodities down until the fourth quarter. As I said, even long-term bonds. Earnings and the stock prices, again, same business cycle, going down, they will bottom sometimes when inventories and sales found the sweet spot. And this is going to be at least in Q4 of 2023. If you noticed in this presentation, I never talked about the Fed, and I did that on purpose. Why? Because I think that the decision made by business is so overwhelmingly more powerful than the Fed that they are what are important to follow. They are driving the business cycle in the financial markets. I know this is not something that is agreed on, but quite frankly, I think that the Fed is not as important as people believe. The other important point to recognize is that all global business cycles and stock market are perfectly synchronized. All the turning points are perfectly synchronized. So to believe that there is a bear market in the United States and a bull market in Korea or in India, I would be very careful with examining if that decision is the correct one. Well, I publish the Peter Dag Portfolio Strategy and Management. You can get a free subscription on www.peterdag.com. You will see all my articles, all the data to support whatever I presented in this. in this video. I wrote this book, Profiting in Bull or Bear Market. This book was commissioned by McGraw-Hill Education and is available in the US and in Asia in many languages. I also published Easy Ways to Beat the Market with ETF and Investing Wisely. It is easier than you think. And again, all my articles are found on www.peterdag.com. I really appreciated you following this video, and thank you so much for your interest, and please send me your feedback. I would really appreciate it. Again, so long and Happy New Year.